The TFSA is hands down the greatest gift the federal government of Canada gives to its citizens. If you're Canadian and don't have a TFSA or have no idea how it works, I consider that financial foolishness and to a certain degree irresponsible. Sorry for the tough love, but it's true. If you're new to do-it-yourself investing, it's most likely the first account you will open, and if you're a veteran investor, it's most likely that your TFSA is already full. Whatever category you fall into, this video will be beneficial to you. So I will quickly review the 3 main benefits of the TFSA account, and then I'll review 3 very important features that all Canadian dividend investors should know about. So benefit number 1, the contribution room, or the amount of money which you're allowed to put into a TFSA, does not have to be earned and is the same for all Canadians. So unlike the RRSP account where you actually need to earn your contribution room with your taxable salary income, with the TFSA you get it automatically no matter what. All you need to do is be a Canadian citizen. That's it. So the contribution limit increases every year since 2009, the year this account was invented, and the exact amount is determined annually by the Government of Canada. Also, any unused contribution room is carried over to the following year, so don't worry about losing your contribution space. So if you turned 18 in 2009 or before 2009, you're entitled to the maximum amount of $75,500 as of January 1st, 2021. If you turned 18 after 2009, well, you could simply use an online tool to figure out what your overall contribution limit is during any given year. So I will add a link to a very simple and easy online tool in the video description below that you could use to figure that out. Benefit number 2, all the income generated from all your investments within a TFSA, whether it's interest income, dividend income, capital gains, capital appreciation, whatever it is, it's all tax-free. So it's tax-free as it grows in the account, and it's tax-free when you withdraw it from your account. If you got super lucky, let's say, and bought Tesla or Shopify or Netflix and made a capital gain of $100,000 or even $2 million, it doesn't matter, it's all tax-free. So yes, that is why the TFSA is such a precious gift. Now, one quick note to mention about dividends, so I'm 100% correct in what I'm saying here. Any US dividends from US listed stocks like Apple or Microsoft will still be subject to that 15% withholding tax. There is nothing you could do to get away from it. So don't worry about actually paying the tax to the IRS yourself. It's done automatically. It's taken right off the top before the dividend even reaches your account. So again, this only applies to US dividends from US listed stocks, not Canadian listed stocks. Capital gains, however, is tax-free no matter what, even if you make millions of dollars and even if it's a US listed stock. Now, just a quick warning if you're a trader and not a buy and hold dividend investor like myself. If you do a lot of trading in a TFSA account, so buying low and selling high, your TFSA account might get flagged by the government, and this activity will actually be considered a business and not personal. So the TFSA needs to be considered as an investment vehicle and not a trading account. So unfortunately, if you're a trader who trades often, you will be flagged and will end up paying taxes. So I'll put a link in the video description to an article that explores this in detail. But if you're a buy and hold long-term investor like myself, there is nothing to worry about at all. Benefit number 3 is that you can withdraw money whenever you want. It will always be tax-free no matter what. So unlike the RRSP, where you cannot really withdraw money early, well, you can, but you'll need to pay all kinds of fees, penalties, and taxes. With the TFSA, it's just the opposite. You could withdraw whenever you want, it doesn't matter. So you have full withdrawal flexibility, so to speak, with the TFSA. That is the main advantage that the TFSA has over the RRSP. So in a nutshell, guys, those are the 3 key benefits of the TFSA. Amazing, right? That is why I said it would be foolish not to take advantage of these amazing benefits. Now, if you're already investing on your own, you probably knew all of this already, but now I will share 3 very important features that all investors need to fully understand. Okay, so important feature number 1, any money you withdraw from the TFSA increases your contribution room dollar for dollar the following year. So that's right, you could increase your contribution room yourself when you withdraw money from the account. Only thing is that you need to wait the following year starting January 1st for it to take effect. And this is on top of the new government limit for that year. So if you withdraw $6,000, let's say, from your TFSA in a given year, and the new annual limit is $6,000 like it is for 2021, you will have $12,000 of TFSA room instead of only $6,000. So this is important to know for us dividend investors because our primary source of income comes from dividends. Now, of course, you could just leave the dividend money in the account and reinvest it, or simply turn on the drips. But for value-oriented investors like myself, where I want to decide myself what to reinvest in and when, it's a good feature to understand. All right, feature number 2 that I want to discuss. You can maximize tax savings by strategically choosing which investments you put in your TFSA. So this is especially important if you're planning on maxing out your TFSA, which should be a common goal for all Canadians if you ask me. Now, I won't get into the details on all the tax implications for all the different types of stocks. I'll cover that in an upcoming video where I'll discuss that in detail. But long story short, you should try to put funds in the TFSA that are taxed the most to maximize your tax savings. So the primary type of stock that comes to my mind right away are REITs, or real estate investment trusts. This is simply because the income REITs generate is usually taxed like a regular income. So if you compare that to capital gains or eligible dividends, which are dividends from Canadian corporations, REITs are taxed more. So putting high-yielding REITs in a TFSA is a solid choice. So what I personally do for my TFSA is hold a mix of my highest yielding stocks and as many REITs as possible. That way I'm not only maximizing my tax benefits, but I'm liberating as much room as possible for the following year. Alright, so feature number 3, you could contribute to your TFSA by transferring stocks from your cash account to your TFSA account. This is called an in-kind contribution. So this tip is more for investors who already maxed out their TFSA account and have a regular cash account for the rest of their investments. So as soon as January 1st hits of the new year, you don't need to wait until you accumulate your new contribution space. Let's say it's $12,000, for example. You could simply transfer $12,000 worth of shares from your cash account to your TFSA account. You will instantly get the tax benefits if you do this. So whatever the value is of those shares the moment you transfer them, that's your contribution amount. So one thing to note, however, if you do this, is that if you're transferring shares that have capital appreciation on them, so your shares are higher than the price you bought them at, it will still trigger a capital gains tax event in your cash account. So if you broke even on the shares, however, or you have a capital loss on them when you do the transfer, you will not trigger a tax event whatsoever. So it's very important to understand. So in summary, you do need to declare and pay capital gains tax if you're up on a stock that you transfer, but cannot claim a capital loss if you transfer a stock that you're down on. So I know it sucks, but that's just how it is. So me personally, I like to transfer stocks that I have a big loss on. I'll explain why right now. So capital losses, don't forget, can only offset capital gains. So since I'm a buy and hold investor, I don't really declare much capital gains anyways. So if I have a fund that gives a really high dividend and it's down 50%, like a split corporation for example, transferring it to your TFSA makes perfect sense to me because it's costing you 50% less contribution room. So if you transfer high yielding stocks that you're down on, you're getting more efficiency in terms of TFSA contribution room. So don't forget, the more income you make in the TFSA, the more contribution room you could free up for next year. So you want to try and generate as much income as you can in a TFSA. So transferring high yield stocks that you're down on can help do just that, even if it means giving up the capital loss. So I hope all my points were clear and concise and that you learned something from this video. If ever you're confused about something or have any further questions, don't be shy. Leave me a question in the comments below and I'll be more than happy to answer all your questions. So because of several requests that I received and keep receiving, my next video will do a deep dive on taxes. So in a two-part series, I will tell you all you need to know about taxes when it comes to investing. So I'll go over all the tax implications with the TFSA, RRSP, and cash accounts in detail, and even talk about the 4 different types of investment income since they're all taxed differently. So very important stuff if you're a do-it-yourself investor, so stay tuned. That's coming up along with, of course, more dividend stock picks. So as always, please hit the like button if you learned something from this video. I would really appreciate it. And if you're interested in dividend stocks, strategies, tips, etc. related to passive income investing, make sure you subscribe to my channel because that's what we talk about here. So with that, thanks for watching guys. Stay safe and see you next time.